Hello and welcome to the Vancouver Resource Investment Conference channel. We do hope you've been enjoying all of the footage from this year's VRIC. There's literally 100 videos plus right now on the channel with all of the presentations, the panels. So do check that out. But of course, we are bringing the VRIC to you with our series of expert online panels. And I'm very excited for the one we have lined up today. We've got Josh Young from Bison Interests and John Polomny of the Actionable Intelligence Alert here to talk energy, the oil and gas space, a topic near and dear to my heart. Gentlemen, it's an honor to have you on the show.
Thanks for having me.
Thank you.
So let's start off with just a broad overview at the moment of the energy space. You know, before we hit record here, John, you were saying the market's been tough. It's been up and down quite a bit, and that certainly is the case. As a kind of a newer investor to the space myself, I began investing in the oil and gas sector in around early 2021. I have also felt that pain in my portfolio after seeing it go up a decent amount. But I obviously maintain long-term conviction. I wonder what both of your thoughts are on the current state of the oil and gas market, how you see it developing moving forward, and any areas right now that you might be seeing opportunity in. And Josh, I'll start with you.
Sure. Yeah. So I was just chatting with a friend before this, where we were talking about how I was considered a complete idiot in 2020, and then total genius in 2022, and then I'm getting back firmly into that considered total idiot space, and I feel most comfortable operating in that. From a commodity perspective, you want to invest, you want to deploy capital when sentiment is very negative and when people just don't believe both in the commodities and in the equities of the producers and services companies. So, I think just broadly, it's a great time to be deploying capital in this space. It's a little rougher if you deployed capital a year or two ago. It's not so bad if you deployed it before that. So starting you were sort of back to 2021 levels in a lot of the stocks. Some of them are doing a little better, but I think it's really compelling overall. I think there's great opportunities in small cap equities that haven't gotten lifted with the fund flows into indexes. I think there's great opportunities in certain services which are sort of undersupplied or are about to be undersupplied as prices rise. And then I think just for the oil price, I think it's interesting to see counter-seasonal inventory draws, and I think we're actually potentially setting up for a pretty big move in oil to the extent that that continues. And again, my short-term crystal ball, I'm not sure what to expect short-term, but it looks really good from inventories in the recent past.
And John, your thoughts on the current state of the oil and gas space, where you're currently seeing value, if any. Do you think that now is a good time to enter the space as well? Or do you think it's worth waiting here for further potential correction?
So I think you need to kind of distill down a little bit, right? I mean, I wouldn't just say, yeah, go buy XLE. There's definitely opportunities. Josh talked about a couple of them. You have to realize something when you say you're an investor in the oil and gas space. You have to approach it from the perspective of the fact that it is a commodity. It does fluctuate, but there still is opportunity. So where do I see opportunity? I'm very bullish. I was just going over through some of the earnings reports of some of my holdings, like in some of the offshore services. One of the main subsea contractors reported earnings today. They were tremendous. It looks good going forward. I like some of the long life reserve companies in Canada that have a shareholder focus to return capital. I'm not going to mention any names on the call, but there are some out there that are lower debt. They have different thresholds of debt. As they lower their debt levels, they're increasing buybacks and dividends. So I think there's opportunities in those type of things. And I think one thing to remember is investing is about, number one, looking at, okay, what's the risk-free return? Okay, if I can get 5% in T-bills, it's like any other allocation of capital, not just in oil and gas, but anything. Is this potential allocation that I'm thinking about doing, is it going to potentially give me a return above what I consider risk-free? So there are opportunities there, but I think people really need to understand it's an extractive industry. I'm very bullish on it in a 3 to 5 year term. Why? listen to what Vicky Holub said. What is Warren Buffett doing? Why is he buying? He's almost bought half of Oxy now in Chevron. We have not. We've had. My thesis is the same as it's been for the last couple of years. You're going to have short and midterm fluctuations in the price of oil, but I think what you have tremendous underinvestment that's taken place, and you've seen a lot of the industry around services atrophy because of that. And I think the spending will come back. I think that we are looking at higher prices at some point in the future. And I think there is opportunity, but I wouldn't just say, just go buy the XLE. I think you really have to be selective and you have to do some work and you can find opportunity.
I'm wondering how both of you go about adding to positions and exiting positions, because this is obviously a very volatile trade. From a psychological perspective, it can be difficult for a lot of people who don't truly understand the intricacies of it. So starting with you, John, I wonder how do you approach adding to positions? Do you add on weakness? Do you dollar cost average? And same question when it comes to knowing when to take profits off the table in this sector. Do you do that bit by bit? Do you sell entire positions? Does it depend on the situation? Yeah, give us your thoughts there.
So I do like mostly bottom up. And so I'm looking at these companies individually, the managements, the properties, the location, what some catalysts they may have, what have you. And I write all this down in my journal. And then when I take the position, I'm thinking, I think I'm trying to find something that somebody maybe the rest of the market hasn't realized. And you have an opportunity in Canada right now. I think in a lot of the some of the companies, it's just ignored. You have, for example, you have a situation where in the S&P itself, this has been pointed out many times. I think Josh even tweeted on this. I know I have. You could take the market cap NVIDIA. You could buy the entire S&P energy, all the companies in energy in the S&P, and have money left over. So the sentiment, I look at sentiment, things like that. So you ask me, when do I buy? When sentiment's low, I mean, it was obvious. It was a layup when the headline was negative 47. You could have bought company for 10, 25 cents. I mean, I think I bought Athabasca Oil Sands at 25 cents. It's like $5 now. I mean, I don't own it anymore, but those are like obvious, you must buy situations. Similarly, when you have like, when we had the invasion of Ukraine, we had this big spike in oil, and it was probably a good time when sentiment was very bullish to pull back. So I think that's more of I don't have any set rules for that, but that's kind of how I do it. I keep my finger on the pulse, and I just review my positions over time. And if we get in a situation like we are now, where prices and sentiment is not that good, there's opportunities to add here and there. So I don't have any set fast rules. It's more of like, does this particular company doing what they said they were going to do? They are in a double-digit cash flow yield. They continue to lower debt, which is accretive to me. They continue to buy back shares, which is accretive to me. I don't care if the oil price goes up $10, $15, $20 one way or another in that type of scenario, because I've bought it for a different reason. So I hope I answered the question, but it's more of a subjective answer than objective.
Yeah, that makes perfect sense. And Josh, I'm wondering from your perspective as a fund manager that invests in the oil and gas space, obviously you have a very unique perspective, and a very different set of responsibilities than your average retail investor. So how do you approach knowing when to add to positions, when to exit positions, and do you have a strategy for that?
Yeah, so I think I have a lot in common with John's approach in terms of trying to sell when everyone's really excited about stuff and buy incrementally trim when people buy when people are really sort of despondent or really sort of hate things. I think there's maybe a few sort of specifics that I think I can share. So one is, and I think this is sort of obvious from sort of some of the stuff we've put out at Bison, but we track transactions very closely. And, sometimes companies overpay or sometimes they get really good deals in the private market, but it's helpful to sort of get the temperature in terms of valuations in the private market. And then see public market reactions when it's public companies that are doing acquisitions or selling to sort of calibrate that sort of analysis. So we've done that a lot for years now. And so, John mentioned Oxy, and they just did an acquisition, and it was really interesting to see the metrics on that acquisition, on the Diamondback acquisition that just happened. On, the Oxy one's really interesting because Berkshire's bought a bunch of stock after they did it, so Berkshire's essentially sort of sanctioned it. Right, like they've approved it essentially. I mean, they don't have governance control over the company, but Vicky has been, I believe, to Omaha since the deal was announced, and they've been buying a lot of stock. So they, unless they've sort of, I think they haven't checked out Buffett style. You can see the snowball in the background with the Canadian I love Canadian oil hat on it. So I think it's helpful to track that, and if you can own something at a big discount to transaction value. Sure, nothing's perfect and nothing's identical, but if you can own things that are pretty similar, understand the differences, discount them or add value depending on those, I find that's really helpful. A couple other things. One, valuation, I think, matters a lot. There's a weird refrain that I've heard a lot. It's sort of a two-part thing that people have said a lot, but it's sort of precisely wrong. So one of them is that large cap companies should trade at higher valuations than small cap companies. And it's just wrong. I mean, it's true in bottoms of cycles, but it's never been true in the tops of cycles. Always, you've had the small cap growth stocks trade at really high valuations. I mean, you don't have to look far. You look at tech, right, where you see the small tech companies years into this bull market trade at really high valuations, way higher than the Mag 7 for the most part, the Facebooks and Amazons and Googles and so on. And so I think that's like one indicator when the small caps go for these very big discounts. You can buy them at 2 or 3 or so many times cash flow. So I think that's an indicator. And then that sort of valuation discount is particularly compelling, especially where companies are doing things that either make them really attractive buyout candidates or are really sort of returning capital, like John was saying. And the one difference I would say is I don't necessarily care so much. I like it when companies trade at large discounts and buy back stock, but I'm more indifferent to NAV per share debt adjusted. And any sort of value creation, whether it's buybacks at a discount, whether it's acquisitions that are highly accretive, whether it's just transforming the company to look more like other companies that sell for large premiums relative to where a stock is trading. Any of those I'm very open to. Have to be executed well. There has to be good integration if there's acquisitions. There has to be good cost cutting if there's dispositions. But anything like that, I'm very open to. And again, that sort of that disconnect in terms of like what everyone says. Oh, and the other part of it is there's this idea that large caps recover first. I heard that probably 500 times starting in 2020, and it was totally not true. You could see the stock price trajectory, and again, the valuations for the small caps are really low. But if you bought like Exxon, let's say in 2020, you up about 3x plus dividends, maybe 3.5x. If you bought Athabasca, which actually, John, I think I was buying it right around then. I think my entry point was like 19 cents. I didn't hold it all the way through. I sold $1 something, whatever. It was great. Not indicative. I've also owned stuff that's lost money, whatever. But, if you bought it at 20 cents, even you could buy it at 20 cents. And I think it was November of 2020. You could sell it or maybe 19 cents, whatever. I mean, today, like you said, it's at 450 or whatever. So huge move, way, way, way more upside relative to the large caps that everyone said, oh, they're going to go up first, go up more. And it was just nonsense. So those two things, everyone's saying it, again, just ignoring the history and the data and just saying it because they heard it or they think it sounds good or it rationalizes their position. To me, that's really exciting. And the more I hear stuff like that, the more I just want to go buy cheap small caps.
Well, let's tackle the recession question. This is the biggest kind of bear counterpoint that gets brought up. It's amazing because I talk to a lot of people about investing in commodities, and it is polarizing. There's two opposite camps, it seems, in many cases. Some people who believe it makes no sense at all to invest in energy here because we're going to have a massive recession, and that is just going to drive down demand and kill energy prices. I'm thinking of people like Harry Dent. I spoke to Michael Pinto the other day, very bearish on the sector. And then you speak to other people such as yourself, such as I recently talked to Adam Rosenswag and put this question to him. And he gave a very fascinating answer as well. Doomberg's a little bit in the in the camp of believing that there's an abundance of energy at an affordable price up ahead. So there's just so many divergent opinions, and it's very difficult to determine as a viewer of these interviews, obviously, without doing your own due diligence, which camp makes the most sense. So I'm wondering your thoughts on the recession question and how it might affect the price of oil and gas. John, I'll start with you, because I know you believe a recession is coming for the United States, and a wider recession. We've already seen Japan potentially in a recession, at least according to headlines. Germany, of course, parts of the EU. How could that affect the price of oil?
So I used to be in the camp that a recession in the United States would affect oil prices drastically. I'm not really in that. When you look at history, you have to understand the world's kind of changing where demand is coming from. And so, yes, the United States can have a recession. The amount of energy input would go in, would decrease to some extent. But if you look at the history of in the last at least 30 or 40 years, I think that I looked at the chart and demand has only decreased like 3 or 4 times. And one of the times was the great financial crisis, obviously the pandemic, when everybody was locked down. There were a couple other times. And so demand is relentless, especially now in the emerging markets, where you have the swath of people that's probably, it could be anywhere from 4 to 5 billion people. Everybody knows. I did this exercise in my email last week to folks. You can go on and find the data very easily, what the per capita use of oil is, where oil use is growing. And I think that will dissuade you of the view. Can you be in a situation where you have a recession in the United States? If you have a recession in the United States, the stock market's going to probably go down. The average is 30 to 40%, something like this. Will oil stocks go down? More than likely, because they're oil stocks, and stocks go down when the market goes down 90%. But these are opportunities. And this is one of the things I think you have to incorporate. But, again, you go back to the situation of when are we going to have the recession? Because I was looking at, a lot of people smarter than me, Michael Cantrell, Mike Green, all these people. A lot of people were looking at, David Rosenberg, this is a 45-year veteran. Where's the recession? So inevitably, you're going to have economic cycles. What I would suggest is one of the things that I follow is the fact that it's the rest of the world, really. It's the emerging markets. That's where the demand's coming from. We're constrained by supply. Any burp that we have is going to be temporary in the price. We're not going to be in a situation, I don't think, where as an oil investor, you have to worry about oil going to $30 or $40 a barrel and staying there for 18 months. It simply won't happen. The demand will just increase greater in these other markets. You look at per capita use in the United States for oil at 21 barrels a person. In India, it's like 1. Where's the demand coming from? You have 800 commercial airliners in India for 1.4 billion people. Southwest has that many planes. Who has the most planes under order? India. So you see the trends. And so any temporary price decrease, whether it was caused by a recession or something like that, I think would be an opportunity to pick up good companies like we talked before. I don't think you're going to see, I think the world's changing a way where people shouldn't really focus on what's happening necessarily in the developed world one way or another. 1 or 2% change in demand supply. It's not relevant really longer term, midterm. I think the emerging markets is where you concentrate. I just don't think it's that big of a deal.
And Josh, your thoughts on the recession question?
Yeah, I think John makes some great points about large portions of the world population getting into that S curve where they're sort of growing demand. It's really interesting looking at China, where China is almost definitely ignoring their official data in an economic downturn, and looking at where they're using oil and how many sort of the oil bears over the last, let's say, 2 years have thought that Chinese demand would cap. At first it was 13 million barrels a day, then it was 14, then it was stories about, China's exporting all the oil they're refining. Now it looks like 16.5 million barrels a day of net demand. And that's with their real estate economy basically halted, a bunch of other commodities in the toilet at 52-week lows, and supplies down a lot of those commodities because of bad pricing. And so really remarkable situation in terms of demand. Exactly what John was saying in terms of the potential for demand growth or stability despite a recession. Europe's in a recession already. Japan, it looks like, is in a recession. And there's no doubt that like Germany's in a recession, for example. The US may have been in one. We put out a couple of white papers over the last couple of years. People thought we were being defensive. We were just trying to analyze this question, say, okay, like what happens? And what will, where do you go? What do you do? How do you navigate this? And I think the most interesting thing to look at is even in a different world where there wasn't this sort of inflection in emerging markets, when you look at the recessions in the 70s, right, and you look at what happened with oil prices and oil stocks, you already had the move in oil from the highs in 2022 to the lows, let's say at the start of this year or a couple of different times last year. That move down of almost 50% from the high to the low was around what you saw in recessions where it actually mattered a lot that the US was growing or shrinking in the 1970s. And yeah, there were Middle East wars, and yeah, there were shipping lanes disrupted. And yeah, that's not actually that different from what we're seeing today. And so I think, again, it's not a perfect analog, and the world is very different. But history, they say it rhymes, it doesn't repeat. And so I think it makes sense to think about sort of even if you were very bearish on the US economy, very bearish on the global economy, if you look at history of these sorts of economic downturns and you look at where we're at, actually we might already be pricing in for the equities, I would argue, especially on the small cap side, right? Some of the 7 or 8 or whatever times cash flow, larger caps, I don't know, like I'd be scared owning those if there was going to be a US recession. Like John was saying, like if there's a market pullback, those things get destroyed. But owning stuff at 2 or 3 times cash flow on an oil price that's already arguably pricing in, it's certainly not pricing in current inventories. It's pricing in pretty big inventory builds globally. I think it's already sort of priced in. And so if you're bearish the economy, maybe you want to own some of this stuff anyway. And if you're bullish on the economy, I think oil and gas related equities and other sort of similar commodity related equities may actually do a lot better over the medium term than the very hyper popular tech and various other things that are already sort of displaying the characteristics that you'd look for as sell signals in oil and gas stocks.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
So for many who are only paying attention to the mainstream media, they truly believe that a green energy revolution is underway, and solar panels and EVs are soon going to make fossil fuels obsolete. I mean, there's a lot of people out there who still consider oil to be something evil. They look down upon it as if it's something we need to get rid of, something that's bad for humanity. And the answer is here, and it's clean, green energy. And thank God the EU and other governments are stepping up and doing their part. I can't help but laugh at such statements as I make them. I'm wondering what your thoughts are on that narrative. How real is this new green economy? And does it place any obstacle in the path of fossil fuels? And John, I'll start with you.
Well, I think everybody on the internet knows my feelings on this. So I approach this as a physics problem, an engineering problem. I'm in the industry. Under no circumstances with the current technology will solar, wind, batteries, EVs replace what we have in place now. It's just not going to happen in the time frame that we're talking about that's investable. I don't know what will happen in 10 or 20, 30 years. Anything's possible. I never say never. I've learned that a long time ago. Anything can happen. What I will say is that even you can come to my job site. I'm building a solar farm an hour from my house. Nothing out there the stuff that brings the solar equipment there is all diesel fueled. All the equipment on the site is diesel fueled. Everybody drives to the job site in diesel pickups or gasoline powered pickups. So it's just not going to happen like that. And we already have experimental little labs where this has been tried in Germany. in the energy vende and in California. It's a disaster. It won't work. And the market eventually asserts itself. Reality asserts itself. Ford's lost $4.6 billion in EVs. If they don't change course quick, and activists will come in and throw out the family and the board. And that'll, and same thing in Mercedes. Mercedes announced today that no, we won't actually be 100%, electric vehicle by 2030 in Mercedes. We're going to extend the ICE technology part of our business further. So I think if you understand, I'm not going to get into, climate change and all that. I'm agnostic to that argument any longer. It doesn't matter. What it matters to me is that what are the 7 billion people around the world that don't have the lifestyle that I want to do, and they want the lifestyle I want, and that's going to be facilitated by the use of hydrocarbons. And the problem is, I'm a generalist investor. This is his field. The problem is we've underinvested, we've demonized it, and so we've really set ourselves back. And that's where I think the opportunity is, because we've created this huge underinvestment gap, not just in hydrocarbons, but in a lot of resources. We see it in uranium also. I'm not going to get into that. But ESG, I think, has peaked. You even have certain banks and investment firms now are reversing their views on not investing in oil and gas because, hey, the bottom line's the bottom line here. And you can't look at the chart of 10. I mean, who's buying that? No one. So I guess that would be my view on it. You can look at places like Norway where they have all these EVs, petroleum demand. And the other thing that I think it's like people really are misinformed. Last thing I'll say on it, transportation fuels are one component of oil use. It's not the only use of oil and gas. Everything that we have that basically for civilization has a lot of components and inputs of oil and gas. And I just don't think that that's just going to go away because you put more solar panels up. It's just not going to happen. So that's about all I'll say on it. And I think the time that we've wasted on this nonsense and this idea for the last 10 years has just further set us back and creates more of a potential when this violently reverses. We're going to have supply constraints in oil later this decade. They're going to be severe. Vicky Hollub said that's why Warren Buffett's buying Oxy and Chevron. This is why people that know this stuff, you mentioned Mr. Rosenzweig, he's done his analysis. You can see the underinvestment is been too much. And so we're living off the carcass of previous investments from decades ago. And as that goes away, we're going to find out that, this didn't happen like we thought. And then I think reality hits and the market asserts itself.
And Josh, your thoughts on the new green economy, and also any light you might be able to shed on what you're seeing with institutional investors. Is this kind of diehard, we must only invest in ESG, is this starting to wane? Have you seen that trend occur?
So while we've been talking during this interview, Nikola has continued to produce 0 electric trucks. So it's worth highlighting that. That was internet joke for a while where they're still quietly producing no electric trucks, and it's terrible. People lost billions of dollars on that. It was a fraud and awful. I think it's sort of indicative. John touched on a few important things. So one, when you look at economies that are much more electrified, they actually don't really cut that much sort of structural oil consumption out. And so if you just let's say you skipped India to using the oil intensity of Scandinavia, right, where they have huge EV adoption and so on. You're still talking about 10 or 20xing their oil consumption. Maybe I might even be undercounting that. And then you look at other economies. India is actually relatively developed compared to parts of sub-Saharan Africa and various other spots. So it's not what you think. The billionaires that have sort of funded a lot of these movements and so on fly around to things like the Super Bowl or to these environmental conferences in their own private jets. So they clearly personally don't mind. And then what I found really interesting is I moved to Houston in 2016 to spend more time with oil and gas executives and to better understand sort of the private universe and meet a lot of people working in the space. And to be closer to a lot of the fields and so on. And it is shocking the number of billionaires who are publicly funding divestment campaigns from oil and gas who are privately funding oil and gas activities. I mean, it's astonishing when you find out the names of these people. It's just, I mean, there are literally, some of them are funding or own media companies that are very averse to oil and gas, and they're funding what, so they obviously, like, their actions are very different from their words, and then their sort of ostensible philanthropy. It's very odd, and I don't know how to sort of square that. On the endowment side, institutional side, it actually looks like that's pretty sticky in terms of their divestment, and that actually you're still seeing, I think, like New York State just came out recently and they're divesting more. There were a couple insurance companies recently that cut back even more. I haven't really seen much in terms of reversals, in terms of groups that are sort of intentionally investing more into the space. Which, again, to something that John pointed out, I think JP Morgan's really led the charge on this over the last number of years. They've been sharing these, they call it super cycle in 2019, which was sort of tough because then oil prices went negative. So any of these things in the short term, we can all seem like idiots. I like to joke that my short-term crystal ball is broken. But over the longer term, we've grossly underinvested in oil exploration and in delineation. And so people see these short cycle projects. I actually strongly disagree that shale has peaked. It has not peaked, and there's millions of barrels a day more to produce from shale in North America. And the analysis on that's it's just fundamentally wrong. And like, it's one of the benefits of spending time with the folks that are doing it and getting to see the actual land maps and so on. It's not peaked, but it's going to take a lot more rigs and a lot more service intensity is rising even with fewer rigs. So it's going to take way more rigs and way more services and people and energy to actually get it. But we'll see more production in the U.S. from shale, and especially Canada will see even more production growth for oil and natural gas liquids, just at much higher prices, which is where that sort of peak cheap oil thing kicks in. Yeah, you can get it. It's just the service intensity is rising. The cost of those services is rising, not falling. And that's sort of the driver. If you look at what it cost 5 years ago, the reality is that it doesn't cost you the same to drill a well. And it also doesn't cost you the same for, a hamburger or whatever. Everything is sort of reset. And for oil, it's actually resetting in real time higher and higher. So that divestment and that sort of concern, that sort of like manufactured concern around green energy, ostensibly green. Again, these economies that are supposedly very green are very oil intensive, way more than in India or sub-Saharan Africa or so on. So the ostensibly green sort of movement has just deprived longer cycle investment, which is going to send is way higher. Buffett talked about it. Munger, while he was still alive at the last Berkshire meeting, talked about it extensively. He talked about how he would keep oil in the ground because he'd rather have it in the ground now to be able to have more in the future. And then on that point, just it's a slight tangent, but natural gas right now has crashed in the US and Canada because of malinvestment in the US. And there's a set of companies that are actually sort of dumping, it looks like, gas uneconomically, like they share their cost curves and they're producing at half of them. And they're like, yeah, we're the low cost producer. And it's like, well, if you need $3.50 an MCF to hit your return hurdle and it's at $1.70, and you are contractually allowed to, you don't have any minimum volume commitments or other stuff. So you shouldn't be malinvesting like that. Some of them are public companies, which raise all kinds of questions around subsidies they're getting in other businesses and virtue signaling, all kinds of weird stuff. But I think it's worth pointing that out, just because amidst this sort of green malinvestment sort of bubble, which is bursting, and a lot of these stocks are down and so on. There's this bust going on in natural gas, which I think is offering these great opportunities too, and is sort of covered by this idea. I think it's hard for people to see because they think, oh, solar panels and wind turbines and all these other things are going to solve this, when they're actually structurally increasing the need for stuff like natural gas. And we might be sort of at or near that sort of $0 or $- oil moment with natural gas. And again, it's not like I'm a Super Bowl, but you sort of need to get back to that 350, and you probably need to fire some of these management teams that are just like, some of them are cutting back, and that shows you that others can too. And you're in this sort of weird situation. And I think it's relevant from a green perspective, because I think they're actually sort of making it look better to do solar and wind and so on by crashing the price and also temporarily suppressing inflation in an election year. But as that sort of unwinds, because it's inherently, when you destroy value like that, it is unsustainable. Like it undoes itself through them getting fired, through them going bankrupt, through having other sorts of issues, whatever. At the other side of that, whenever that is, it's going to be a great opportunity, I think, across the hydrocarbon space and other commodities. And John, something you had said about that sort of negative oil moment and the green energy aspect reminded me of that with natural gas.
Can I ask one question of Josh real quick? I'm intrigued with what you said. I don't want to hijack the interview, but your view on shale continuing to expand, do you see that across all the basins or primarily Permian shale, or what? And what does that mean vis-a-vis? Because it looks like a lot of the smaller independents, yeah, they if they can make money, they're going to go out and drill. But it looks like there was discipline among a lot of the larger landholders, and as it consolidates, like Pioneer CEO used to say, we don't care if it's 50 or 150, we're only going to increase production by whatever it was, 5 or 6% a year. I can't remember, but that type of mentality and focus more on shareholder returns. So I guess my thinking is always you're in this Red Queens race. So when we say it's going to expand, I mean, how much can we expand in your view? And is that across all the basins? At 150 oil, yes, drilling activity picks up across the whole everywhere. You bring on stripper wells, everything else. But can you expand a little bit on that real quick?
Yeah, so I think that higher oil prices are inevitable. And so it's not that I think that oil production is going to rise a lot at $75 oil and sub $2 natural gas. I'm certainly not saying that. And I think there's a decent chance we've already pulled back from the claimed highs in the EIA reports of like 13.3 million. We're under 13, it looks like, and there's not amazing data when you try to look at all data sources versus just government figures. But even the government figures have been sort of coming down, which is awkward because they're sort of claiming that production is growing, but then their numbers are shrinking, and you sort of get into these weird situations. But the satellite data and other stuff, it looks like we're sort of closer to 13, which is down a little, or 12.9 million barrels a day, down a little. So at current activity levels, I think you actually see shale production shrink a little. And I think you might need, let's say, another 50 rigs or so, plus or minus a little, to be able to keep production flat to growing that sort of 5% or so that the public companies are guiding to. And then to be able to get a few million barrels a day more, you certainly need higher oil prices. It's just a question, or way less supply discipline by these large producers, or some combination. So again, I'm not saying that we're going to see what we're seeing in natural gas. I think the natural gas thing is a good reminder of how bad certain companies' governance was in oil for so long, and how disciplined most of these oil producers are, right? Like Oxy could increase their rig count and grow more, and they're choosing not to. They chose to buy Crown Rock, and could they have paid a little less and bought XYZ other things? Sure, but like it's still way better for the oil macro, and probably for them to buy Crown Rock than to try to grow uncontrollably. So I think there's sort of a few things in there. So one, you're not getting that at $75 oil. The industry is telling you the cost of supply, the marginal cost of supply is higher, which is why they haven't increased the rig count and the production's coming down. That's a different thing. Peak cheap oil is very different from peak oil, even from like a basin. So if you look at this recent deal that was just announced on Chord and Enerplus, where they're merging in the Bakken, they're forming the largest Bakken company. They're actually creating drilling locations by sort of sticking their land together. There were locations that wouldn't have made sense, that have been too short, or it wouldn't have been economic for various operational cost reasons. And they're lowering the cost of operating in the basin through that sort of consolidation. And that's not just happening in North Dakota, it's happening across other basins. And so I think when you look at that, you end up opening additional development opportunities and additional potential higher production. I actually am not sure that the Bakken can grow much more. Maybe you could grow another couple 100,000 barrels a day in North Dakota and Montana, maybe. But it's less about the Bakken and more about, when you look at the Bakken and the Eagle Ford and the Midland Basin and the Central Basin platform in the Permian and the Delaware Basin and then the Northwest platform, there's various places where there's a lot of inventory left. You just need much higher prices to motivate access. So yeah, at $75 oil, maybe the peak is 13-ish million barrels a day in the US. At $150 oil, using your number, it's probably 16 or 17, something like that. Maybe some of that Utica stuff EOG is doing and others are doing starts kicking in. Some other basins, you start adding inventory. So yeah, I think it's just a function. I don't think it's a function of rock. I think that is a aspect, but I think it's primarily a function of oil price and then service costs. And service costs right now they're rising in a way that people don't really want to talk about or acknowledge. And I think it's really, again, very bullish for oil, reasonably positive for the producers because they disproportionately benefit even with rising service costs from higher oil prices. And I think it's just going to embarrass a lot of the folks that are worried about recessions that are bearish oil or think there's plentiful oil. Again, like you just look at the companies and look at how hard it is for them to grow and look at these excellent companies with the best teams and the best service providers. And they're maybe, like you said, grow 5% where they used to grow 30% or something like that. And in some cases, they're growing 8%, let's say, but it's mostly through acquisitions. So they grow 2% or 1% organically and then go and buy stuff and then they show growth. So anyway, more of an oil price function, lots of different stuff that I addressed there. And but I just don't think it's rock that's needed. Like there's not plentiful rock to be able to flood the market down to 50 or whatever again, at least in North America. And but there's also enough that if prices were higher, we could certainly see much higher production.
Great insights there, and definitely appreciate the question, John. I want to get a little more insight into how both of you evaluate companies when you're making an investment decision. And obviously, this is a very broad question. You could come at it a million different ways. It depends on the nature of the company. But what are some of are there any guidelines that you go by when you're examining companies in the energy space? Any red flags you look out for? And John, I'll start with you.
So my perspective is going to be a little bit different because I'm a retail investor, generalist investor. I care about like cash. I'm a Walter Schloss disciple. Most people don't know who he is. He was a very famous value investor. So I like cash flow. I like how can I extract, I'm buying a business. I'm buying a possibility of a stream of the cash that can be returned to shareholders in one way or another via debt pay downs. We talked about this earlier, dividends, buybacks, whatever. So I kind of approach it from that perspective. And then I think when you're dealing with extractive industries, I really, management is very important. I want to be in business with people, around people that have done this before successfully, demonstrably, that are incentivized properly. You have to really look at the incentives. You see the change of incentives just in shale from the beginning of shale, where it was just based on production and drilling as much as you can, and the industry destroyed capital, into it's changed now to more of returns, and people are incentivized more that way. So I'm looking for things like that, making sure the management, obviously the property, the assets. You can have a mediocre asset and an excellent management team can extract full value. You've seen where people have had really good assets and squandered it or didn't manage it properly. So I think that's kind of how I look at it. I am not trying to. Again, it gets really easy at the extremes. You just buy things that are like really cheap and over indebted, and buy a basket of them, and most of them will probably make it through if the oil price goes up and you make 10 or 20 times your money. Conversely, at the top or near these extremes on the other side, you sell things off. But I think in this kind of market right here, you have to really understand what you're doing, because if the oil price is in kind of this little sweet spot here, some companies can, their managements can extract quite a bit of value and benefit shareholders. But if you can really muck it up too. So that's kind of how I look at it. I approach it as a generalist. I'm not an expert geologist. And so a lot of times, I'm going to be shying away. I learned my lesson in small caps a long time ago. That's really, you really have to have some real expertise. But I think in the mid caps and larger caps, it gets a little bit easier. If I see, I'll just give you an example. I mean, Josh might disagree with me, but Suncor was a disaster for many years, but then the management's changed now. They got Elliott in there. So I'm not saying it's like as an investment and over overall total return over several years. They have long life reserves. It is a real asset. Things like that, CNQ at certain prices, if you get a price decrease and you can buy stuff, this well-managed companies. So that's kind of what I look at. I mean, do I go down on a limb? Yeah, I have this whole, what I call Latin American portfolio, Ecopetrol, Petrobras, and there's a company in Peru that I'm not going to mention that's a small cap, but they're all paying double-digit dividends. And, I think they're mispriced because people have the wrong view of the politics in those particular countries. But, things like that is what I'm looking at. Take flyers on things like YPF. They have an excellent asset. And if the politics does change there and the market changes, it could get revalued because they have the Vaca Muertas. So I look for things like that, more of a higher level. If you tell, field by field, well by well, looking at the curves and stuff, this is outside of my bailiwick. So I just don't have that expertise.
And Josh, how do you evaluate oil and gas companies? I know you do go into the smaller cap space as well. So maybe you could shine some light on how you evaluate those smaller companies.
So first of all, I think John's being too humble. We've known each other for a long time. I've seen him do very well in these things, and I think I think it's also very smart to have the approach that he has. I think if you Greenblatt says, investing in stocks without knowing what you're doing is like walking through a dynamite factory with a lit match. You might not blow up, but you're still an idiot. So you want to be careful. You want to, as an individual retail investor, consultant advisor, do your own diligence. And frankly, like owning things that are larger, more liquid, and easier to understand make a lot of sense. For what we do at Bison, we like to say we focus on companies with great management, solid balance sheets, which we've sort of redefined as survivable balance sheets. To John's point, sometimes you can actually do really well in things that look levered but are survivable, and great assets for the price that we're paying them for them. And we'll give on any individual one of those, but sort of that's the general approach. I tend to like things in particular that are really misunderstood or really hated. And it's sort of funny because on social media, it sort of awarded me this like very odd sort of positioning where like I don't even really understand the critiques exactly, but the people will have a very negative view of a company because it's, let's say, gone through bankruptcy, or because they don't like what the management team did on a particular transaction, or if they drilled a few bad wells. And it's interesting that I think people are never as dumb as you think they are when they're failing or doing poorly, and they're never as smart or as talented as you think they are when they're doing great. And I think having that sort of very sort of level approach to evaluating things allows you to come in and look at things as a value investor that are they're in this sort of dented and damaged or worse, right? They're getting thrown out, and you pick up things for pennies on the dollar in some cases. And even in up markets, there are these things that become available. John was mentioning Latin America. There are opportunities there, or in services where people see the rig count falling or staying stable and they get spooked. And I guess the one thing I'll point out that I think is just phenomenally interesting, and we have the most services exposure we've ever had in the 9-year history for Bison. Normally, the way it works with cyclicals, excluding the upstream, but just for cyclical businesses overall, you get to buy them at a large discount to their book value. And there's different ways to sort of measure it. Maybe it's a tangible book. And again, a lot of this is actually Schloss and sort of similar. Howard Marks talks about this a little bit in terms of mastering the market cycle. You pick up things at a large discount to book value, tangible book, replacement cost, liquidation value, various metrics. The idea, it's less about the specific metric and more about sort of making sure you're not sort of getting ripped off buying the thing or getting what's perceived as a value trap that can actually never make money or so on, and then sell it when it makes a lot of money. And we're in a very unique time where you can actually buy things at a large discount to their replacement cost or book value that are actually making a lot of money. And you shouldn't be able to do this. And the very few times in history where you've been able to do this have been setups that are extraordinary. So the investment that made Munger's career was an oil services company that he invested in. He joked that the CEO was an alcoholic, but his trucks didn't drink. something like that. So, and I think Buffett was in it in a smaller size. Munger was in it in a large size, and he rolled his gains from that into Berkshire Hathaway, and that's how he became a billionaire. It was like a 1-2 punch. Everything else that's great and all this interesting stuff and Wesco and whatever, but that was it. And so that was a situation where it was, I think they had production and services. It was at a big discount for replacement cost, and it was making money. And these things are so rare, and we're in a time like that right now. So even though we're focused on upstream and we've done really well versus the upstream indexes and stuff since inception, there's just this compelling opportunity on the small cap services side, and then also the small cap producers. If you think about it similarly, big discount to replacement cost, there it's a little less unusual for them to make money. Generally, oil companies, if they're losing money on production, will stop, with a few gas producers aside. And so anyway, that's where we're seeing opportunity right here. And that's, giving away essentially without names, like it's so exciting right now to get to deploy capital into this stuff. And yeah, you feel dumb because they trade down because of whatever, any day, week, month, whatever, sort of doesn't matter. If you look at like Schloss, you look at Munger, they're just extraordinary investment returns. It was this particular thing that we're doing right now.
Well, gentlemen, it's been an incredible conversation. I have learned a ton. I'm going to have to go back and watch this once it's out again to absorb all of this information. Before I do let you both go, Josh, tell us about buys and interests, where people can find that.
Yeah, so none of this was investment advice or a solicitation or anything like that. You can find us at bisoninterests.com. We invest in publicly traded oil and gas companies, and it's a private investment firm that's only available for accredited investors.
You do also have an email list, right? That's available to retail investors.
People can get our email list. What we've been doing is the accredited investors end up on our email distribution list, and we try to distribute most of the content that we think is relevant for just general education stuff like this. We'll put out on we set up a Substack, and so that's sort of more for broader. There's no solicitations or anything like that, and we're happy to sort of complimentary share what we're doing in that sort of format.
Great. Well, I'll put a link to that in the description below. John, tell us about the Actionable Intelligence Alert, what it is you do there, and where people can find that.
It's on Substack now. We just write about these compelling value opportunities wherever they exist: oil and gas, energy, uranium, emerging markets, what have you. We're very eclectic. If it's cheap and has value and has a catalyst to be revalued, we're interested. So Substack, and on YouTube, just put my name in there and you'll see my weekly videos, which some people find useful and entertaining.
Yeah,
by the way,
oh, go ahead, Josh.
I listen to, I don't know if I get every week, but I'd say I catch at least twice a month.
Yeah,
So
no, I've said this publicly many times on Twitter. It's my favorite show on YouTube. Very rarely do I miss an episode. Extraordinarily insightful and entertaining as well.
I appreciate it. Thank you.
Well, thanks to both of you once again for coming on the show, and definitely hope to have you on for a sequel at some point in the future.
Sure, anytime.
Thank you.